And hello and welcome to the Daniels Ag Services 2013 Corn Outlook. Glad you can join us today. My name is Craig Turner, and today we'll be presenting also with Drew Wilkins. First, let's get through some of our risk disclosures. This material is conveyed as a solicitation for entering into derivative transactions. This material has been prepared by Daniels Ag Services broker, who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitation of trades. Daniels Ag Services, its principals, brokers, employees may trade in derivatives from their own accounts or for the accounts of others due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors. Such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risk associated with such investments and their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure access at danielsservices.com. Daniels Ag Services is not affiliated with nor does it endorse any trading system, newsletter, or similar service, and Daniels Ag Services does not guarantee or verify any performance claim made by such systems or services. And finally, when investing and purchasing options, you may lose all the money you're invested, and when selling options, you may lose more than your funds you invested. Strategies using a combination of positions, such as spread or straddle positions, may be risky as taking a simple long or short position. So, again, my name is Craig Turner. I'm a Senior Ag Marketing Consultant for Daniels Ag Services. I'm also a contributing editor for the Grain Analyst newsletter, and I'm author of my own newsletter, Turner's Take. And with me today also is Drew Wilkins.
Hi, Drew Wilkins here. I'm also a Senior Ag Market Consultant with Daniels Ag Services, along with a contributing editor to Grain Analyst. I was the author of the Wilkins Ag Wire, and we folded that into the daily report at Grain Analyst. But we're also launching a video series, so we're revamping the Wilkins Ag Wire as a morning video series, so be on the lookout for that moving forward. With that said, let's jump straight into the old crop situation here. So as you can see, we've got a nice chart up here of the U.S. corn ending stocks to usage ratio. If you look over there at 2012, the far right of the chart is the 2013 estimate, but where we got the mouse right there just a second ago, that's 2012. You can see the last time we were that low was around 1995. So stocks to use is incredibly tight. As a matter of fact, the USDA is projecting it at the end of this marketing year to be 6.82% stocks to use, and that's 757 million bushels as ending stocks. So that sounds like a lot, but that's incredibly tight ending stock, as you can see. You get back to the two previous years before 2012, and you see we're also very tight. But before that, we're over 10, which is sustainable. But looking at a 6.82 stocks-to-use ratio, that is incredibly tight, and that's one of the reasons we're seeing July corn trading almost 660 right now. So old crop carryout is very tight right now. With that said, let's take a look at old crop basis and how that's being affected due to the tight carryout. As you can see, the national average is 30 cents over July futures right now. That's very, very high this time of the year. And also the RIN market has been tight. Sometimes you'll see the RIN market, you'll see it in the news where the RIN market has exploded. RINs are trading at X amount. That's due to the fact that not to get too in depth here with what RINs do, but they offer ethanol blenders the option to not have to blend or the corn into ethanol. So when they buy RINs from other producers, it prevents them from having to use the actual physical corn to produce the ethanol. So when you see the RIN market getting hot, that lets you know that, hey, either corn's very hard to find or corn's very expensive. So we've seen the RIN market be a little explosive lately, and that just tells you how tight the cash market is out there right now. And with the basis being what it is, you've obviously got elevators and blenders bidding higher for corn just because either there's lack of farmers selling or they don't have it in the bins, one of the two. But those two things combined really have us with the basis 33 over July corn right now, which is extremely, extremely high for this time of the year. So with that in mind, let's take a look at what could be considered a substitute for corn, and that's the wheat market. Wheat ending stocks, or stocks to usage, excuse me, is over 20%. Now compare that to the corn we just looked at, where I believe it was 6.85%. Wheat stocks to use is much higher, much more available when you start looking at wheat as opposed to corn. And wheat is a substitute for corn feed. Wheat actually has a higher protein content than corn does. So when you see the prices somewhere around the same level for corn and wheat, you get more protein out of wheat, so it just makes sense. That's why you'll see a lot of people saying that, oh, wheat's a substitute. Look for people to start feeding wheat now. Well, that's due to the fact that it has a higher protein content, and when wheat comes down to corn, we even saw wheat trade a little lower than corn this year. When wheat comes down to around the same price as corn, you'll see a lot of people substitute wheat for corn. And as we've noted, their world supplies are plentiful. We're looking at stocks to use over 20%. So that's one thing to keep in mind. If we see corn and wheat start to converge around the same area, wheat's definitely a substitute, and that could hurt old crop pricing at that point. So with that said, let's take a look at exports here. And one thing that's interesting to note is in 2011 and 12, we exported 1.543 million bushels. I'm sorry, that would be 1,543 million bushels, or 1.543 billion bushels of corn. This year we're estimated to export 750 million bushels. Granted, in this past year we only had a 123.4 yield and 10.78 billion bushel production. So that's one of the things that has caused us to have lower exports. But one of the other things is we've done a really good job of teaching the rest of the world how to grow corn and have a sustainable agricultural supply chain. So you've got people over in South America that are really good at producing corn nowadays and have their export structure is lacking over there, but they're getting much better. So with what we've done, with them, and then Ukraine is getting big in the corn export market, what we've done over the years with helping people with their infrastructure and teaching them how to grow these grains, it's going to take away from our export market. And as you can see, it's doing that for this year as compared to the previous year. Granted, obviously we had a lower production, less to export, but still, that's a huge difference. I mean, you're talking about more than half or less than half of what we did the previous year. So exports, a combination of a decreased production for 2012-13, and also just due to the fact that the rest of the world's catching up with us as far as our efficiency in producing feed grains. So with that said, let's take a look at ethanol and what it's doing. For 2012 and 13, we're looking at around 4.55 billion bushels of corn used for ethanol. You got ethanol production increasing and ethanol stocks declining. So what does that mean? You got ethanol stocks decreasing. Well, you got to replenish those stocks because ethanol is still in demand. You got production increasing too. So we don't see that the old crop ethanol demand as waning. Obviously, we spoke about RINs a little earlier and the difficulty to source cash corn, and that's another reason that basis is so high. Is due to the demand that's out there for ethanol right now. So with that said, let's jump into the old crop carryout. We touched on that. There's nothing. High prices will ration the demand, and we've seen that. Of course, there's also a lack of supply out there too. That's the reason why we're having these high prices. But they will ration demand, and that's where you'll see things like wheat come in as a substitute. We've also got lower exports, more wheat for feed, and ethanol RINs. And also a 750 million bushel carryout. So with all those things in mind, 700 million bushel carryout, the price expectation for old crop corn, we think it's going to stay pretty steady to where it is. Just there's not that much of it out there, and that should continue to support the old crop market as we've seen it here recently, and it also should keep basis high. So with that said, let's throw it over to Craig and take a look at some of the things going on with new crop right now.
All right, well, thanks a lot, Drew, for bringing us up to speed on the old crop. We're halfway there on our path to what we think is the 2013 outlook will be. And let's get on to the new crop. We are figuring in that 750 million bushels carry-in for all the reasons Drew stated. And now we're going to look at new crop. And, the big story lately is the planting delays and the loss of acres. We're seeing anywhere in between 3 to 4 million loss of acres. And We'll see what the USDA says about that. So we're just going to take the average of the estimates and call it 3.5 million acres for now. And there's been also a lot of talk about loss of yield. Not only are we not planting as much, but the late planting with the current conditions may hurt the yield. And on average, we were seeing about 158, 159 average yield, and now the estimates are coming at 153, 154. So we'll have to see what happens there. And you can see on this chart that how late we really are, compared to the last 10 years and last year and where we currently are. We're well behind and got a majority of our corn planted in, maybe 1 or 2 week period this year. As for the supply, we are looking right now at a 153 yield and 93.5 million acres. So that's going to give us about 13.5 billion of production for the new crop. And if we're talking about 750 million bringing in from the carry-in from the last year, that's going to give us a total supply of about 14.2. And you can see here on the chart, this is where our supply will be. So even though we are having these production issues now, or with the weather and the planting, you can see that the production estimate for 13 is still well above where we're looking at, just even compared to last year, and it's pretty comparable to years past. So the new crop supply is still looking good. One of the big questions we've been asking ourselves is what is going to happen with September corn. Some years it acts like new crop, some years it acts like old crop. Where is it going to be? And I think that we're going to probably see when July corn comes off the board that new crop September corn may tend to act like new crop instead of old crop, and we think that's important because the later we go into the planting season and the later the corn gets planted, September stops acting like old crop and starts acting like new crop. And to get a good idea of where prices are going to be, where that transition is going to be made from new crop and old crop, is going to be a lot about September corn and how it prices against December. So that's something we're definitely going to keep an eye on as the year goes on, and from the supply side. From the demand side, we're going to talk about the world supplies and U.S. exports. We do have a lot of supply coming on, not just the United States, but in the across the world. And as Drew was touching about, U.S. exports were about half of last year. And yes, we didn't have the corn to export, but the world still needed all that corn, and they have found other countries to export it from, whether it be the Ukraine or South America or South Africa. So, what's going to happen there? Are we going to get that demand back? I don't know. I mean, we're probably not. We're probably going to lose some of that demand to some of the foreign nations that were able to supply the world this year. There's been a lot of talk about peak ethanol. How much more can, based on the government mandates, how much more can we do in the ethanol demand? I mean, right now a lot of people are thinking, it's very difficult to get over 5 billion bushels for the demand side on ethanol. And the other thing is with demand, whereas, there's ethanol, there's exports, and then there is the feed and the livestock. And we've already reduced the herd so much in cattle and hogs, you just can't increase those animals, with a snap of a finger overnight. So even if we do have the corn and there is an increase in feeding, are we going to get all those animals that we've lost over the past few years? So, demand in the livestock can't bounce up to where it was to maybe 2 or 3 years ago. It might take a year or two to get back up there. So demand could be weak. And giving all those factors, the supply and demand that we just talked about, we do have our table here, and these are our new figures on what we think are going to be planted for corn up here, and what's going to be harvested, which is generally always 92%. That's the industry average. And then because we just do not know the yield, we have planting delays. We could have a great summer. The summer weather is usually what makes the crop. We have different yield numbers, from 140 to 160, which I think is a pretty good range of where we could be. 160 would be now the absolute best, where we would just have such great summer conditions we'd actually add to the yield. And then of course if things start to deteriorate, we'll have the 150, 145, 140. And if we bring in our beginning stocks from here and our production, and we get our total supply numbers, and we as we talked about that feed and this would be our ethanol number right around here and our exports, you can see we're looking at a total use of about 12.5 billion bushels. And where are our ending stocks going to be? And we can see that, if everything just goes our way for the rest of the year, we might be around 2 billion ending stocks and 15% stock to usage. all of a sudden we're talking about sub $5 corn, maybe even like $4.50 corn. If we stay around here, this 155 level, and we have ending stocks of 1.5 billion, stock to usage of $12, we can be talking now maybe the high fours, low fives for corn. If the conditions keep on getting worse, and we go to the 150s, 145s, and let's say 140, now because we have such a small beginning stock, and we get a 140 yield, all of a sudden, we don't think we'll get down to 238. Some of these numbers would really have to come down again, like the exports and probably some feed and probably some ethanol to get this number back up to 600. But that's when we start seeing price rationing come in, and that's where we get the $6 and $7 corn scenario. So this is really, as we'll be going, the yield is going to be a big thing between now and the summer on where we are. And then, of course, as we talked about before, what's going to be really the feed number, what's going to be the ethanol and the exports. And throughout the year, we do update these. And right now, we're kind of in this 150 to 155 yield. This is our carryout, maybe 1 billion to 1.5, just based on the crop conditions. And we're talking really maybe around $5 corn for 2013. So 550. Our conclusion is 550 is the high end for corn. As there's probably 50 cents of weather premium in December corn right now. And that's why we think 550, 560 is more of the high end, where when the weather premium comes out and we get the production that we think we're going to get, we'll probably be more around 5. But, summer weather, it's very critical. And, the USDA demand is based on cheap corn. So, one, we have this other summer weather, and we'll see how that affects the yield. But two, the USDA demand is really pretty high in those tables, but it's based on what they were thinking was going to be $4.25 to $4.75 corn. If we're at $5 corn, we may not have the production that we thought, but we also won't have the demand. So that's what we're looking for December corn. With that, I'm going to switch it over to Drew.
All right, so thanks, Craig. So before we get into the specifics of what we're looking at here as far as opportunities to potentially take advantage of in the markets, Craig and I are both registered as brokers. So that really limits what we can do as far as things on webinars and videos. And so just real quick here, because we are registered and this is a webinar, the NFA has regulations discouraging us from sharing specific trade recommendations with you during this event. However, we do have very specific strategies for both hedgers and speculators based on what we've discussed today. We encourage you to contact us to learn the exact strategies we'd employ based on your circumstances as a trader or producer. Once again, before you enter any trade, you should know and understand the risks of trading futures, options, and spreads. So with that disclosure said, let's take a look at some of the things we're looking at here. We can't, like we just noted, there's no specific recs we can give. Give us a call for those. But taking a look at December corn, we think 550 is the top end of the range with no material summer weather issues. Obviously, as Craig noted just a few minutes ago, weather is the ultimate thing. Summer weather is critical. But with no material summer weather issues, we think that 550 is the top end of the range with these corn. Out of the money calls for extreme weather, for extreme summer weather. It's just out of the money. Taking a bank on the fact that, hey, if something does happen, just like last year, for example, we saw the market spike up. Taking a look at some out-of-the-money calls for things like that. We believe that 450 will come in at a harvest low, and looking at some put spreads to try and take advantage of that. So those are just some baseline, real vague, or not vague necessarily, but a broad overview of what we're looking at as far as recommendations. As noted, Craig and I both have very specific ideas to take advantage of these thoughts. Give us a call to take advantage of this. You'll get our numbers and emails here in a sec. So with that said, let's throw it back over to Craig to take a look at some of the offers we've got for you all today.
All right, thanks, Drew. Yeah, we have two today. We have our Grain Analyst, which is we have two services on there, free and premium. Andy Daniels writes our Insider Perspective, which is where a lot of the information came today for the webinar. Andy also has his trades and daily grain updates in there, and you can even follow him on Twitter, which anyone can follow him on Twitter at Grains Guru. There is a premium service, which is free for Daniels trading clients, but anyone can subscribe to it. And it really is a great resource. Andy's very connected throughout the grain industry, and highly recommend it. Even the free service is a great product. I also write a newsletter called Turner's Take. It's a free weekly newsletter, and I focus on the grain, livestock, and energy markets, primarily in future spreads. We also have hedge ideas too. You can follow me at Turner's Take on Twitter, and we also have the links to both of those products there. From here, we'd like to go to any kind of questions in a Q&A session. Our numbers, me and Drew, our numbers and email addresses are down here, and if you look underneath Daniel's Ag Services, the 800 number to the main line is there too. Be happy to go over any of the specific trade recs that we have, and we will open it up for questions now. All right, well, I'm glad we got those questions out of the way, and now that the webinar is over, we do have to follow a little compliance here and just go over the risk disclosures one more time. And here's our first risk disclosure. Again, here is the second risk disclosure. And finally, here's the third risk disclosure. If you'd like actually a copy of these risk disclosures, we'd be happy to send them to you too. So that concludes our webinar. Thanks for coming, and there will be an archive. Thanks very much.